Hi guys, welcome again to another lecture. Really good to have all of you here. By the way, if you want to watch this lecture, you're more than welcome to. If you haven't watched the previous lectures, I would definitely suggest you start with those and work your way to this lecture. This is a lecture series primarily on market profile. If you're unaware of what that is, then again, I've got in the description a free course on market profile. I've also got a Udemy course on market profile that will bring you up to speed with some of the things we're going to talk about. In this lecture, I discuss a lot about market profile in detail. I did look at trades in detail. I look at positions, all from the right side of the chart, so you know exactly what's going to happen, what I'm thinking, and where things are going to go. I'm giving you a really in-depth look. Never going to find anything like this all over YouTube. The bottom line is that if you want to really understand what's going on here, you probably need to look at the previous lectures. So start from lesson 1. I've got a whole playlist here, so please utilize it. Okay, moving on. So today we're going to talk a lot about shorter term profiles. So here we're coming into the topic of segmentation. Now, for some of you, I've spoken a lot about segmentation, but I haven't really tackled segmentation in the way I'm about to. If you've seen the previous lecture, you notice we did cover segmentation a bit, but one of the things that we haven't talked a lot about is risk management and how do we actually make these trades. And I'm going to show you all of that today. But before we do that, I'm going to give you a bit of a walkthrough now because there's a lot. I didn't put out any lecture videos over the past couple of days. I was incredibly busy, lots going on around the world, lots of markets. As all of you know, I trade for a living. So what I'm doing here is when I have time and I can make time to do it. Most of the time I can afford to put out a lecture, give or take. I got to record this lecture, try and get it edited. So, I might put out a lecture, 3 or 4 lectures a week. I really try. Some weeks, obviously, I can only afford to put out 2 lectures, and this was one of those kind of weeks. So if you've been eagerly awaiting my lecture, and you've managed to go through, of course, all the rest, and you're like Speedy Gonzalez and you've gone through everything, that's perfectly fine. Again, yeah, that's the delay. That's what happened. That's why you haven't seen any new lectures. But here I am. All right, moving on. I brought up a chart of cable. So I'm going to walk you guys back from the beginning to where we are currently. So this here is a daily profile, I believe. Monthly profile. I'm just going to check this, by the way. I have to keep tabs on this. Okay, so this is a weekly profile of cable. Right, so this is the weekly profile, and we've spoken about this before. So I've got a few profiles up here. So we've got a weekly, we've got a daily, and then we've got this segmented hourly profile. So I'm just going to drag them close to each other so I can keep track. Right, so if we look at what's happened, right, and we think about everything that we've been talking about, one of the things I said to you guys is that I believe cable was gonna eventually go down. And why did I think that? Was because at the time we'd started to see what was a lot of draw on stop losses, right? Which, as you all know, that's part of my liquidity model of my trifecta, which is liquidity, volume, and time. The liquidity part was taking place at a market high, at a known high. So there's going to be a lot of stops there. The market reaction on each week is evidence of that. So you can see we went through those highs, pull back in, and then we hit the bid stack. That's the volume part of the trifecta. Then we went up again, draw on the highs this week, came back, hit the bid stack. We did the same. We pulled up, we drew on the liquidity at a high here, came down, obviously a lot more aggressively. This time, what did we do? We went through this bid stack, but we hit this bid stack, right? So what we're evidently seeing is stops being run, new buyers coming in at bids, and taking the market back up, running more stops coming in bids. What we haven't seen this week, which is actually unusual, is we haven't seen a run on stops on last week, and we had a massive neutral profile. What did I tell you guys about neutral profiles? If you see a neutral profile, it's a lot of volume. Essentially, a lot of people are either buying and selling at this level or doing both. So if you're seeing a lot of selling at a high, draws on liquidity, it's definitely giving you vibes that it's going to go lower. So my perspective, if you look at the previous lectures, it's not what I'm saying right now, is I had an expectation that cable was going to drop, despite showing the upside a lot. But one thing I did say to everyone is, if you're short-term trading or you're swing trading, well, you don't have to trade the entire weekly profile. You can just literally trade points in it. In this case, we've got 4-hour rotations. If I break this down, you can clearly see we pulled down in I period into a bid stack, and then we struggled, and then we started to break structure, right? So we see this P period rotate going up. Well, that's a good long, right? That's 130 pip long on a week, or with a point within the week. That could be all you need to do in a week, right? So you don't need to over push it. If that's not how you trade, then don't over push it. Just essentially take the trade that's available to you. So again, if you're confused as to seeing the bid stack, let's put one in here so you can see where that is. Right, that's the bid stack. So you can see us trading into it and bouncing out, and that's really what we want to see when we want to be able to get onto trades, right? Especially if we're looking at a week as a picture, right? So us driving in here was a clear sign that the market is ready to do another run, possibly a run on stops. Here now, we come down, and if I split this profile, look at the difference. We come, we hold, we don't bounce, we go through it. Now we're coming and we're retesting it and breaking lower. That's the first sign that, one, this bid stack is no longer relevant. What we do in that scenario is we just simply delete it because it's no longer relevant. The price has traded comfortably through it. There's no reason why we should think that this is going to create a level of support anymore. It did that for 2 weeks. So even if you're trading long at the top of the market with good risk management, there's no reason why you shouldn't have some good trades on a swing trade, right? So this was the longer time frame picture, was that we had a draw in liquidity. We're back in now. My expectation is we're going to break this bid stack too, right? We might not do it all this week. We might come back, retrade. I think we'll stay under the liquidity level for sure. We'll retrade and then eventually start coming back. What we should start thinking about is the fair price. Are we going to open next week, trade the fair price, and then come back out, for example? Right, that's where our head should be. It's Wednesday in the week, and we've done a massive extension already. We're really pushing the range of the week. So we're doing a lot of it up to midweek. So at this point, we can only expect that if we're going to get lower prices, we need to see the L period logo, and that will continue lower. Are we going to be buyers? Hell no. Or what, are we going to be sellers? No. We're going to look for the potential for us to trade one of these liquidity levels on the week and then bounce. So that could be the V period low or the K period low. And that's where the rally is probably going to come from. So again, if we draw that out here, these are the levels we're looking for the market to attack if we're going to get a decent rally. If we start to rally from here next week, then we're looking for the market to retest the fair price and come down, and we'll search for weakness at that point. Where's that likely to happen? Well, there's going to be minus development here, right? So again, for those of you who don't know what minus development is and haven't been following the lectures, well, essentially that's very similar to unopposed selling, or what in certain circles will be called some kind of value gap, right? Exactly the same thing. So we got strong K period price action. If anything, that's where we will trade to and most likely struggle. If we start to trade above the K period high, then we're looking at possibly a draw on the E period liquidity, which I don't expect. So for me, the market is now fully bearish long term, right? Which essentially means that these are the levels we want to start to consider for buying, right? So draws on liquidity, again, this is not quite value low, close enough. In fact, I would argue that there's a high chance now for us to come back into the bid stack here or potentially draw liquidity at D period low. So I'm expecting a really, really big drop in cable. All right, so the daily picture, is the daily picture reflecting the same idea? So let's pull back. If we pull across here, we can see we had a run on stops, not a problem. You can see that as well, equally, if you wanted to make intraday trades, there were opportunities to do that. So for example, we saw an initial run on stops here, pull back in the NASDAQ. Let's say you went short, right? Let's say you were stops above and you got hit on this week, but then we pulled back in Asia, strong D period run. So as soon as we can get a price level somewhere between the minus development, well, then we want to apply short with stops above the high again. Eventually this became a really huge stop. So we don't care about the volatility that we're going to see in coming days. The fact is, as profile traders, especially if we're using my trifecta model, where you're looking at everything in step by step, you start with a longer time frame, you work your way in, you look for the draw on liquidity, you look for the run into bid stacks, which confirms volume. Are we coming out of that or not? That could be part of your strategy. And you look at the time equation when you're taking the trades. So as long as you're doing that, the chances are you're going to get a lot of high probability setups. So again, we can see that here. Let's say you were trading this day. What did we see? We saw the NASDAQ come in here, then the Chicago, and then this huge wash and pullback. So again, what we've seen? We've seen another draw on what was a liquidity high. And then also we've seen a session draw, right? So this was the NASDAQ opening Q period. So by the time we came into Chicago, we can see Chicago ran the stops in the NASDAQ and closed lower, right? So that weakness that showed up in Chicago was probably a really good opportunity for you to be short, right? Again, you'll see if volume in the smaller time frames was a cue on this day as well to take this lower. We'll probably see that in the shorter time frame, shorter term profile, my apologies, segmented. So what can we see here? Huge drop. Where do we go? We go much lower and we start to seek liquidity. Of course, this is a huge drop that happened US yesterday or the day before yesterday. Right here we can see we formed a gap in value. Always gaps get filled, but we're really struggling to fill this gap at the moment. So we'll have to see how the subsequent days fare on. Can we go and fill that gap? If we do, that will be the last thing we're going to do is fill the gap and probably start to sell off again, right? So again, now we start thinking lower levels. Right, let's delete some of these lines. So we're thinking lower levels. Where are we going to go? Likely we're hitting the bid stack. That's a good, whoops. That's a good place to start to aim to see a return, right? Bid stack. And that's what we're seeing. We hit the bid stack, we pull back up, right? This was a good trade out of Asia. Yeah, that was a pretty decent trade. If you're trading long out of Asia, this was a pretty good position to be in, right? Hit, pulled out, went, did a run, 36 pips. Right, okay, slightly bigger risk, 20 pip risk, right? Didn't quite make the highs. But we've got this gap in sight, so there may well be a rally. This might not break lower yet. We have to be conscious of these things. Again, we've got another bid stack to the low. So if we do come through here, we're going to expect a level of support. So the way down, especially when you're not catching the top of the move, the way down can be choppy because of these stacks, right? So, but they also present opportunities if your strategy is to primarily buy off bid stacks, for example. Right, so we've got a picture of daily. Now let's work our way in. Right, so this is what we're saying on an hourly profile, right? So hourly profile, 5-minute rotations. Now everything comes into play when you're on time frames like this. Every single thing. You have to be Johnny on the spot. You really need to know what you're doing. Liquidity, volume, time, all happening really rapidly. The good news is that you can really handle the time equation well as an intraday trader. You're not tempted to trade at times where there isn't the conditions that you're looking for. Right, so let's talk now about a lot of risk management when we're trying to do these kind of trades. And we're going to talk about just today, right? Because again, we're coming into that NASDAQ open, but most people will be largely traders in London. There was the inflation report today in England, and they're going to be traders in Asia. So we're going to look at both sessions, what that looked like and where we're coming from in previous sessions. Now, if you look at the big price action, volume 7191, huge, definitely eclipsed the volume that came in end of day, about 4 p.m. London. And of course, we had even a further break at 5 p.m. To conclude the FTSE, right? So if we're looking at all these, you can see that the volume's pretty light relative to the one that we're seeing on this profile here, right? Which was 17th of June, profile, 3 p.m. Chicago. So what have we got? Huge volume. So this essentially is a lot of minus development on the 1 hour itself, on the entire profile. So if you look at what I mean, is you can see that there was unopposed selling between here and here. So the market getting over this point is going to be a struggle in itself regarding this frame. We can see exactly where the highest fairest price is, which is value high. We can see it's exactly at 35.29, which means that the market should stay relatively under that price going forward. So any shorts, now of course I don't like being short in the hole, but seeing what happened in Chicago, any shorts should mean that stops will be somewhere above value high. There's a lot of structure here. We've got minus development here, overextended profile, which confirmed minus development on the break here, so that would have been a late observation, but as soon as we closed this period here, it was clearly minus development, right? That's a 15 pip position, and look at the drop, right? You're not always going to get that. We've seen an expansion in volatility, and this was really being short in the hole. Everyone knows what I talk about when I say being short in the hole. But if we factor what was happening on the higher time frames, there was a really good case, even if you wanted a late short in Chicago, to carry overnight, because that for me always is an overnight carry. Clear to see everything that's going on. Not difficult to observe. So we have this key level. We understand that the higher points in price are going to be of relevant, which for me is somewhere between value high and the open, right? So or the high of day, whatever works, right? This is like some nuance that you don't need to over debate. You can look at the highest day as a potential or somewhere to the open. Right, open's high enough anyway. Right, so we trade lower, we keep going lower for the rest of the day. Right, and if we look as we go lower, volume's weak and then it peaks 5738. That's a climax, right? So we're basically seeing that traders are now trying to catch this, right? They're trying to support this market. So I'll always take note of the low, right? Because that means that if traders are trying to catch it, what are traders going to do below limit orders? They're going to put stops, right? And stop orders are hidden orders. You can't see them. Only the broker knows where they are, or the intermediary, which means that information can be sold to others, which means that information can be used to get into trades. So anyone looking for a high amount of liquidity that the market doesn't know where it is going to reference this kind of information. What do we see? We see a lot of trading just to the bottom of this low, and the market seems not to be able to go lower, and volume continues to decline. You can see that on here. So you can see the volume going lower and lower and lower until we're at this point. It's pretty much end of day, volume's completely dried up in the market. And then very slowly, it starts to creep back in at about midnight in London. It's 2 a.m. in Europe. And then we're back above, we finally close above on this bar here, which is 2 a.m. London. So immediately, you're thinking to yourself, well, how do I get in? Clearly the market's ready to go long, right? Because we've seen a draw in liquidity against the prior day, and now we're into a new day into Asia. They're probably going to take this long. Where are they going to take it long to? Well, we've already had this conversation. We're probably going to fill the gap, or we're going to sit at value high. Value high is a safe bet. But you can see exactly value high, right? Nothing sinister here. Now, if we split this, we've seen the 4 a.m. Close, 4 a.m. Europe, 2 a.m. London. Right, now we want to get long. What's my rule when it comes to entering trades? Always come in at a bid price if you want to go long, which means wait for it to drop to the lowest fairest value, which is value low. Somewhere around value low is always a good entry. So we close up here, wait for a slight pullback into value low. What are we looking for protection? Below value low, we can be below the previous value low, which is a safe bet, or below the low of this bar. That's 7.9 pips. We're looking to take this to value high. Well, that's 41 pips. Good day. Well, it's a particularly a good day because we had the inflation report coming out of the UK at 7. That helped give the market some fuel to get us up here, right? So a lot more volatility. You can see from the shape of that profile that a lot more people were long at the highs, and that is the reason why we also had a draw on liquidity at this session, which is clear to see. So you can see the pile up, you can see the market push, take all the stops, including anyone sitting above value high, trade into the minus development, and then come back out. Right, so this J period print has held the market down. So what happens? We pull back in If we wanted to get short, again, as a rule, we think, seen a liquidity draw, we're going to get short. Where would we be aiming for? To the low of the inflation report. We're going to see some volume there, because why? Anyone long on the inflation report would put stops at the low, and that's going to cause a draw in liquidity, and that's going to push us up. Where are we likely to go? Well, we're probably not going to beat the value highs if we are bearish on this market. So the market's going to struggle to get above value high, which will indicate that we're still pretty bearish. We will start to reshape that narrative when we arrive at a given time when we're going to get liquidity that can eclipse the liquidity that we see in London, which is 7 a.m., 8 a.m. liquidity, London open. The next open is going to be New York, and the next one will be NASDAQ, and the next one will be Chicago, and NASDAQ being the most important of those ones. New York is kind of like a lot of new stuff going on, and that's great, but NASDAQ is the one you want to pay attention to, because that's when the equity market's open, that's when everything goes crazy. It's 2:30 NASDAQ, even the grain's open. There's a lot of dollar activity. That's why we care about it. There's a lot of dollar activity. So if we know there's a lot of dollar activity, well, that's where we want to get involved. And then you've got Chicago, which is all the big futures guys. They might think NASDAQ isn't right. And you also got the stock traders who trade the golden hour, the 10 a.m. guys, right? 10 a.m. New York. So all of these play into what I call the Chicago session. When the Chicago session opens, that's what you want to watch, because that can change the game. As you can see, we saw that here, where the Chicago session, 5 p.m. Europe, 3 p.m. London, changed the game. Right, you can see that huge break. This was the NASDAQ. The NASDAQ set it up. Chicago killed it. Right, so this is the session you want to pay attention to, because any big drives that you weren't seeing in the NASDAQ open at 2:30 is going to happen at Chicago 3. So there's literally a half an hour window. That's why for me, 2 to 3 is relevant for NASDAQ, 3 to 4 is relevant for Chicago. I need to see the session conclude, unless the NASDAQ has given me a good enough clue that we're going to go short. In this case, for example, that was the case, and we can discuss that. But for now, let's just stay at the right side of the chart. This would have been the next play. Now, I can't tell you what's going to happen next, right? On the NASDAQ open, one, we could use this value low as a support, and then we could go higher and draw on the liquidity here, because that's the next point. So I want to see one of these situations play out. I want to see this situation play out where we draw liquidity there and then set it up, and then we come lower, or we continue lower, we hit one of the bid stacks here. So in other words, we use value low as a support reference, and then we look at a potential draw at liquidity here, right? So one of these scenarios is what I'm looking for. So you can see where all the liquidity points are that are going to be relevant. Split this, you can see that here. So I'm going to be looking for a decent clear, because obviously we got quite a few lows. You want a decent clear. You expect the market to sweep a hell of a lot of this stuff, possibly even sweep into the lows here. This will be more interesting. However, don't be surprised if we sweep the lows even lower, right? Which means that if you have a short position, you don't need to do anything as we crush into the lows. As we hit those liquidity lows, you can start to manage it, right? So let's say, for example, you saw the draw come in here at 8 a.m. London, and you're short in London, and you want to carry this through to the US session, right? So typically, like I said, if we split all these rotations, that's what this would look like for you on a 5-minute chart, right? Split everything up, right? And if you look at what's happened here, once we pulled back in, let's say you're short, stops can be here, they could be here, whatever takes your fancy. I just like to be above value, high or low, with a relevant liquidity level that I can aim for, right? So that makes it about roughly 6.5 pips, right? So I'm sitting on 6.5 pips. We did 26 pips already, right? Well, I'm going to come out of the trade. I'm not going to hold this anymore. That's the first thing. But that's what that setup would look like. And what have we seen the market do? We've seen it do a draw right down here. So I can see the draw, and we've closed up. This was early Asia. So that sets up a trade for me again, is to trade around that draw. Again, very easy, stops just below the low, give it some distance, maybe below this low, right? Don't be too greedy, or even here, 7.7, that's not bad. And then you run it, well, we got 21. That's exactly a 3-to-1, exactly a dead on 3-to-1. So if you were sitting on 6.5, then you'll be clearing this trade somewhere about 21, 20.9 as well, equally, right? So either way, you've set yourself up. So now we're printing, let's have a look, period, 2 p.m. NASDAQ. So now we've got the NASDAQ print, and then we can see where this goes. And that's how you make a trading decision. So you're trading a time that's relevant, right? So you should start to see maybe the NASDAQ reference value high, right? Before going lower, if it's going to go lower. If we start to see the NASDAQ eclipse and hold above, then you can immediately anticipate that since we're trading above value high, if we can clear all the value highs, we're going to look at a draw on liquidity pretty soon. But these value highs are quite sustaining, so it does really tell me that value perception is really dropping. So I'm not really expecting that that's a possibility. So now that changes my directive, and I start thinking, okay, let's see what the NASDAQ does when it crashes and starts to run stops that are likely going to be sitting down here. Now that's going to get interesting. We already have a bearish bias, so we don't really care at this stage. We know that we're potentially going to be lower. So if you're in a short position and you're still trying to carry this short, or you are saying, well, I was short and I'm still expecting short, then your goal will be, as soon as the market can trade back into the fair price, and I think this thing's going to keep going lower, and I'm going to have a short close to fair price, stops above the highs, or stops above the highs here, whatever works, right? I would preference a stop above the highs, about 6.5 pips. Get a short in. Well, I'm going to go for the draw, right? I'm going to bet there's going to be a draw on liquidity here. So I'm going to say, well, look, I'm going to trade this either into value low. I'm going to trade this in for a draw, right? That's already quite a big risk reward on using the profile, but also a 5-minute rotation window. Right, so I'm taking all the emotion out of this. If you notice, there's no emotion. These profile charts don't really give any kind of casino feel. They don't give a gambler's feel. So you just really do what you can statistically see as relevant points, and that's what you're using to risk manage, right? So I promised you guys to talk about risk management today a lot. Right, so that's one way to develop into a position. But obviously it's outside, for me, my time trifecta. 1 p.m. New York Open is great, but I also know the NASDAQ can easily eclipse New York. New York is not that major of a trading center relative to NASDAQ. It's a period where we have a lot of news, and that's okay. But NASDAQ is really what's going to point the way, and I need to see a full hour, 2 to 3 p.m. I'm not looking to jump into trades. I'm not eager to do that. I need to see a full hour before I take the trade. I trade cable a lot. I've already had my trade today in Asia, so I don't need to take any more trades. I trade cable or not, I like trading the earlier sessions for reasons I've explained in the previous lectures. It's a lot to do with where I am in the world right now. However, that being said, you can trade the Asia, you can trade Europe, you can trade NASDAQ. I've just shown you a trade from London, right? That's how I would have traded it if I was trading in London. I didn't trade that, I didn't take that trade, I didn't have that position, right? But if I was gonna make a trade, that will be the only trade for me to make. Because I would have concluded we had 7 a.m. inflation report, ton of volume should have been there, and it's the highest volume so far. And then we had a draw on liquidity at 8 a.m., which is when I look for a trade. As soon as the 8 to 9 closes, I start looking for trades at 9 a.m. So I'm not really going to be looking for trades before 8 a.m. And occasionally, if I thought that there was an opportunity to trade at 7 a.m., trade location was good, then I might consider that. But either way, 8 a.m. probably has to happen for me before I can really feel like I can make a move. And this is important, guys, because you have to have that fixed point. I've told you in previous lectures, if you're going to get any degree of profitability, you need to have a fixed point you trade from. You have to have a really good system for managing trades around your fixed point. And for me, my fixed point is always time. That's why I have my trifecta. I've got time, I've got volume, I've got liquidity. It doesn't change. It doesn't. If it's 100 years today, that's what I'm going to be doing. I'm not going to do anything else. Like, there's a lot of ways to trade. I've experienced a lot of ways to trade. I've got a massive Udemy page with lots of lectures or lots of courses. Most of them are free. Some of them are not. They're really cheap. They're as good as free. But it's just a big library of courses of all my experience through the years of different ideas. Some of them work really well, and 80-90% of them will give you a pretty decent edge. But you have to bear in mind, I can't trade all of them. At some point, I had to settle on something. As traders, we keep always seeing strategies. Do the pigeon, do the chicken, do the silver bullet, do the wolf. All kinds of different strategies, right? And as a result, some people, I just play SNR level 1 and 2s, and I play this, and I play fractals, and I play Dodge me Mary, and all kinds of things, right? And the bottom line is that if you're doing all this stuff, you're going to find that you're going to get a lot of significant challenge in terms of narrowing it down into what it is that you feel you need to be doing in order to keep having that consistent execution, which is what we call reps. So you want those consistent reps, because if you're not getting them, then you're not really going to be able to build like a model where you can see that, okay, this particular occurrence happens all the time, so this is essentially my trade all the time. You're not going to be able to build a consistent model. Guys who've done mentorships with me, for example, guys who've been mentored with me one-on-one, I always emphasize this, is that no matter what you learn here, and they learn the whole wheel, they learn everything. Like, you know, I go deep, because it's like a diploma. I go deep because I think that if you don't really get this on a deep fundamental level, where you feel like you're a professional trader, like you have all the, that you can go away and create your own spreadsheets and build your own, you know, your own ideas. You can look at a multitude of assets and be comfortable with multi-asset management. If you can't do that, I personally think that trading starts to feel very much like a struggle, because it becomes increasingly harder than it should be. It's in my opinion, it's always a knowledge gap. It's a massive knowledge gap, and so much of retail do have a huge knowledge gap, and they don't know when to act or how to act or what to act around. And for me, that's why I close that loop. I'm like, nope, you gotta know everything. And if you know everything, where you feel like you and the guy at Goldman Sachs are exactly on the same level, but the only thing you don't have access to is his market making systems, but you're on the same level when it comes to knowledge, fundamentals, and technicals, right? And when I say technicals, I'm talking about stuff like this, not just, you know, basic stuff, the profile, but technicals where you understand what other traders are looking at too. So you understand other kind of technicals that may possess an edge, but you might never trade them. I've got guys who've worked with me who primarily trade volume. I've got guys who work with me who do profiles. I've got guys who work with me who just sell option premium. I've got guys who are futures guys who work with me who probably want to do a bit of options, want to do a bit of this, but they effectively know what it is that they're going to do. They've already found a strategy that they feel they want to focus on, and as they're improving, I can see that feedback and I know that they're going in the right direction. So, but if you're not one of those people and you just catch up my lectures on YouTube and so on, this is the point I'm trying to make, is that you need to have a fixed point. All right, moving on. So you can see we're making a move to the upside, and I expect that we're going to start perhaps testing those fair price levels. Me knowing that doesn't make it a trade opportunity. I'm just telling you, basically, there's no trade opportunity yet. We've already told you where the trade opportunities are. Anyway, I hope this made sense, right? So this is kind of how we look to manage positions. So that was an example there. So let's double back. I did say we'll talk about the day before, right? And then we'll look at another asset and we'll look at the same wheel. So this stuff really starts to cement. That's 2 o'clock NASDAQ. Let's look at what happened prior, right? Same ideas, right? Unfortunately, we run out of data after a while on the profile. So if you're using a TPO chart where your broker doesn't provide you enough data going backwards, then what I would say is screenshot everything going forward in time so you don't lose it. You can always go back and reference it. Create a folder on your computer where you can keep screenshotting and put the dates, put the times that you screenshotted, just so you know exactly where you are in time. So you can start to build a picture. And you know, if you've got a good computer, you can just cycle through them and see what the market's been doing over, 1 year, over 2 years. After a while, you have a ton of data. Of course, when you start doing it, you're not going to have a lot. You're going to only have the look back, but you have a ton of data. So for me, I'm not that bothered. I collect all the data I can on the asset I'm trading. I'm a huge cable trader, so you're in my wheelhouse, right? There's not a lot I can't tell you about cable. All right, so NASDAQ. So let's see, let's go back. Let's go further back in the day. So 17th of June, this is the Asian session, right? So let's say initially you're an Asian trader. So this is midnight, that's 10 o'clock London, Asian market opens. What are we seeing immediately when we set up? Now potentially here, because I can't see the profiles going back, this could have been a liquidity area, but I don't know. So I'm going to use this as a reference, right? So we put in a low, huge rebound. What does that mean? It means that we got stops sitting under here, right? First thing, an Asian trader, right? Next, we got a series of value highs. So these are going to be pretty decent resistance. So at the moment we've drawn on liquidity, so we're feeling bullish, right? And that showed up on the close, which will be the 1 o'clock London, 3 in Europe, right? So as we moved up in L period, that gave the signal that we wanted to be long. Like I always say, we want to wait to see if we can get those value low prices, right? Let's lock this down again. And that should be around here. So we should be looking to get in around about the fair price, right? That's a good level to go. So we trade the fair price, we get stops under the low, 6.5 pips tends to be decent. But again, where you look at where the low is, you can squeeze that even to 5.8, even 5.4. So you get 5 pips in, the market goes for 16, right? That's 3 to 1 solid. All you needed to do was wait for the market to trade the fair price. Okay, you got itchy fingers, you couldn't wait, or you waited too late and it bounced and you thought, oh, it's getting away from me, you traded up here. At 6.5 pips, 15.6, you still got a 2 to 1. Just be conscious where you're getting in. If you know that you've taken a price that's too high and you're not likely to get your level, because like I said, we got a lot of value high resistance here, and we got higher day, right? So there's going to be liquidity up here as well. I say higher day, you've got higher event profile session, right? So there's a lot of levels here that can cause you some grief, right? When it comes to your target. So be conscious of that, right? If you're going to put a trade on here, then it's your fault. If you saw the K period black, so you go, I'm going to jump in, or, I'm going to wait for a dip back just above value high, and then I'm going to go, it's your fault. You paid more for the thing because you're trading above value high. So you're trading an excess long. And then you're trying to risk manage against that, and then you go for 8.5 pips, so you're way outside the ATR now. And then you're aiming for 11. That's all, just a little over one. You shot yourself in the foot. Nobody did that to you. That's all on you, because then it means that you were not doing what I told you to do. And I keep saying, you follow this lecture, you do what I tell you to do. I can guarantee that you're going to be profitable, right? It's not a lot of times you're going to hear people say that, but I can tell you that because I only know the probabilities. It's not that people can't be profitable, it's just that they don't believe they can, and also they essentially don't want to be. They like the idea of coming in and shooting some shots and, crying, oh, I made a loss there. It was it. It's like they enjoy the suffering, and that's okay. Each their own, right? It could be a bit of that, that S&M stuff. It's okay, not a problem. But if you're not into sadism, then I would certainly say that you're going to start looking at some of the stuff I'm telling you is that don't shoot yourself in the foot. Get in on those levels, right? And then start to assess what the market's doing. So we drive in Asia. By this point, we should have our goal. We're done. I don't need any more trades. Yeah, okay, the market's going back down again. I can see we hit that level. We're getting into 8, which is 6 a.m. London. Okay, cool stuff. But it's outside of my time trifecta. I'm not going to take any trades. I'm done. Because the Asia Open was my reference point, and I'm taking a shot in the Nikkei Open, or in the Tokyo Open, which is about 1 o'clock in London, right? That's when even some of the pre-market futures open then. So it's a great time. Time trifecta is adding up for that level. That's an Asian time trifecta, but it's great. I like that one. But then moving on, right? We slowly drive into London, and that's London, right? So what's happening now in London? London session opens. We've got value high standing, and then we open and we close. What do we see in London? We see a draw. Right? And this is part of the point where we know we're not always going to be right. So we see a draw in London. So we go down, open, close a little higher with the draw. Okay, you might think we've seen a draw, liquidity is in place, I'm going to go long in London. Right, we split the profiles, and that's okay, right? Because you're going to get some valuable feedback from this. Right, so London close, we went up, we went high, we did take the highs of this session, come close, and that's okay. We hit this stack, so it looked like there was an intent to go lower, but we're going with our model, right? So what if we want to get long, we need to get long somewhere about value low. We open, we get down to that level, right? You go long and the whole thing breaks against you. Well, yeah, so what? You lose 6 pips and it closes lower. You've got some information. You paid to get information. We lock this back in. We're now under the lows. We're holding. Well, if I wanted to get long, my only cue is to do that now in the US session, because I can see that we've gone under, we're drawing on liquidity, and we're closing back up. So that could open the stage again for me to test the long. Again, what am I looking for? I've already seen what's happened here at K period, so I look for us to retest the higher K, but probably not beyond that, right? Because I can see there's a stack here too, this develops. So I'm a bit worried that if this doesn't hold up, the whole thing's gonna crack. But again, 1 p.m, this is 11 a.m, that's outside of my time trifecta, so I'm not gonna have these kind of trades on. There is no chance that I'm gonna make that mistake, right? Because it's outside of the time trifecta. I'm only gonna trade a NASDAQ, a London, or an Asian session. That could be the futures kickoff, Nikkei kickoff, or it could be the London Open. I said London, it could be the 10 a.m. market, London start, right? So I could have any of those sessions, but I'm not gonna have an 11 o'clock trade. That's lunchtime, I'm not doing it. I'm not gonna have a 2 p.m. Europe trade. That's 12 noon in London, that's deeper lunchtime. I'm not gonna have a New York Open trade because the New York never really calls the shots. It's hard for it to call the shots. In this case it did, but that's not my time. And NASDAQ shows up, now I'm ready. Right, so I've seen draw and liquidity, didn't work. I've seen us pull up to the high, draw and come down, draw and liquidity again. Went up, didn't work, broke down in New York. And then I see us breaking down further in the NASDAQ. So take a moment to think about this. What do you think happens to all the buyers that are sitting on these bars here? Right, so we've got 2 bars long, trying to push price higher. What do you think happens to them when the NASDAQ is closing bids down here? First thing going through my mind is that this is going to be a short night. I want to get short on this. So as soon as we crack the NASDAQ low, right, and I can see there's serious volume, I'm going to go short, right? Because now I'm not looking for 5-minute chart trading times. Right, that's for the sessions that have lower liquidity, so I can get some nice little quick. Now I'm looking for session moves. So break, my stops are going to be above the higher NASDAQ because that's where the defense is going to be. That's where all the big guys are going to have their stops. And then I'm going to want to short to see where this goes, right? And I'm going to be looking to get out of this trade on a time close, which is going to be roughly about sort of 4 p.m, right? Which would probably been about here. Or maybe here, but I would have speculated that I'll be looking to get out about here, right? Because I'll be looking on this trade, I'll be managing, so I'll be looking at 23 pips. I'll be looking to get 2 to 1, never really more than that on a session move, right? Because I'm trading the NASDAQ. I've seen the break of the buyers, and now I want to get in, but I don't want to shoot myself in the foot equally. So yes, I've opted for a break of the NASDAQ lower because of the volume, right? So I can see that we had 5444, 5546. So NASDAQ has the highest volume after New York. If I'm wrong, Chicago will draw the liquidity and then go higher. Let's say you were late, right? You saw Chicago and then you became convinced. Well, then your trade will be a lot lower. I would have taken this trade because of experience, and I have a trading model that says I can trade the break of a NASDAQ low. Now, if you're not that, and that's not your game, you want to be more rigid, then you can wait for the Chicago to play out, trade, and then have tighter risk above value high, right? It's still a session play, but this will allow you to kind of be a bit more clinical with the way you execute. So you can go back to that 5-minute window and say, well, this is going to be traded on a 5-minute basis, which means that your stops are a bit tighter, right? That's about 14 pips, and you potentially could get about 50 ticks on this, right? So that's going to be pretty decent, right? It's more than a 3 to 1. Right, now, again, it's a late in the day move, right? So that's why I wouldn't wait for it if I see a NASDAQ that sets up like this where I'm breaking a huge block of buyers, right? Yeah, and you know, if you've got more sophisticated tools, you probably see this on the order flow. If you're really good at reading order flow, most people are not, but if you are, then you probably see it anyway, and it will also add to your conviction. But I've just been doing this a long time. Yeah, so that's how I would play the NASDAQ, is because I can already see everything. Values depressed, I can see us go up and fail into the bar. I've seen a lot of things already happen in the NASDAQ. So for me, I don't need to wait. I just want to get in, and I use the whole higher NASDAQ. Or you can use the value high. It cuts it down a bit on the risk, 15 pips. It's still going to be a good level. We've had this conversation. Breaking value highs is not easy, especially if you're directionally correct, trading out of a major session. It's not easy, right? Look at London. You know, did we break the value high? Yes, we sort of, right? We came in, we went, took the value high a little bit, and then retreated, right? So, but getting over this level solidly is always hard, which is why when I say set over the value high, I give it some distance, right? At least one letter print, just in case, right? And you can see that struggle consistently to get over it. But obviously in this case, we break the block in New York and we continue the axe in NASDAQ, so it's clearly bearish. 2 US sessions have called it short. I doubt Chicago will go against both, right? So this is a bit of a continuation play where you probably had to see the notes, right? But if you're following the principles, even plays like this, you'll be able to see, because you'll be trying to work out what the time open means. Like, what does this structure mean? That's what will be on your mind. It's like, what is this 2 p.m. trying to tell me? What has it just done? Right? And it's the same thing we're going to assess here, is that we see 2 blocks high. If we lock in on the NASDAQ on incredibly high volume, which would surpass that of New York, then we can start to anticipate that a break of the lower NASDAQ is probably going to push us a lot lower, right? And that's going to attack the liquidity, because I've had the opportunity to see how the NASDAQ behaves relative to New York. If I get a draw in Chicago, for example, and then we rally and close up at 4 p.m., then I know that, okay, if I'm in this trade, it will be an overnight run, right? Or I've got to trade it on a 5-minute basis, which means that I'm looking at getting out of value high or somewhere at those high structures, right? Because that's where the struggle's going to be. Look at the shape of this. This value high is going to present significant resistance if the NASDAQ doesn't shape up, which it doesn't look like it's going to. Right? And we already know from the higher time frame that we're a little bit bearish, with a view that we could potentially kill this block, right? This bid stack, right? We could completely destroy it. So we already know there's a lot of risk on this trade in terms of if we wanted to go for a long side trade. We can't see that yet, right? And you look at the daily profile, there is a gap which is suggesting, okay, we could go long, but you split this, you start thinking we're probably going to draw on Asia before we go long. But this is a risk that we're going to get a whipsaw at some point. But right now, let's see what the NASDAQ does. It's 23 minutes in, so we don't really need to do anything. We just need to see this whole hour print, and then we can make a decision, right? And hopefully, if you're looking at it, you will see this a lot later. This recording is going to be in hindsight now, but we'll have another opportunity, another lecture to play this out, right? And you get the opportunity to see exactly what I was saying and why I would have traded it that way. So we'll be able to see if we did a break of low to NASDAQ. I already told you that if we set up in this high volume and we do a break of low to NASDAQ, I'll go short. I already told you that. I already know there's a lot of reference here that this market is being held down based on its behavior, based on how it's chosen to deliver, how that algorithm has chosen to deliver price to us. I can see that. I can see the problem. I can see what's going on. And I'm willing to say that if the NASDAQ doesn't shape up, if we can't start to hold long back into value and present some support on value low, then expect this thing to continue to go lower. Now it just becomes finding a good trade level. Are you going to trade a breaker low, or are you going to trade a return to value high and then short out of that? What would your decision be? Too early to make, right? But either way, we know that if we start doing a breaker low on NASDAQ around volume, there's a really good chance that we're going to continue to axe lower. Highest volume right now currently, I think it still stands at London. Let's have a look. Does it? 3671? No. Yeah, it still stands at London. So at the moment, Nasdaq has to call that. Otherwise, we have highest volume of the day still at London, right? So we know the stops are up here for sure. So if anything, that's what we're going to start looking at for draws if we go higher, right? So this will be a good trading zone for sure. If we go down, we know that we're looking at draws here, because that's going to be more consistent with the fact that prices are going to be much lower in the coming days, right? So there's a lot of opportunity here. Awesome stuff, guys. Well, hopefully this lecture's been great. I've covered a lot. I was hoping that I could go on to cover another asset, but I can't, run out of time. But till the next lecture, guys, adios.